Hello everybody, in this video we'll be doing the chapter number 23 of CMT level 1 and the name of the chapter is indexes. So in this chapter we are basically studying about the various types of indices which exist in the world markets. For example, we have S&P, we have Dow Jones China, we have Shanghai Composite in China, we have Hang Seng in Hong Kong, we have the Nifty 50 in India. So like that we have various different indices in the various world global markets. We'll be studying about this. The learning objectives. So first we'll be identifying major global indexes, and then we'll be able to also talk about survivorship bias. We'll also be discussing about the weighting methods. What do I mean by weighting methods? So basically, how is the index measured and how is it given a value? How is it weighed? What are the methods which are used in calculating the weights of the indices? That is the third thing which we'll be studying. And the last thing is common non-equity index. There are more indices in the world which are not consisting of equities but other things. So we'll also be studying about those kind of equities, those kind of indices. So what are indexes? Indexes are representations of the value of a subset of the market, whether the subset is very small or almost an entire market. So if you can talk about the Indian index, so we have various indices. The 50 top companies of India is represented using the Nifty 50 index. So this is one such index. You can see the value of the Nifty 50 right now is about 18,567. So this is the Indian index. This is one of the Indian index. We also have an index for just the bank stocks. So these are the banking stocks of India. The Nifty Bank is another index. And if you talk about, so this is Hang Seng, this is the Hong Kong index. So this shows me the Hong Kong index. So we have various indices for different countries. So it basically gives you an overview of the market of that particular area. The most helpful aspect of indexes, especially in the equities market, is that they help the technical analysts drill down from the country level to the sector level to the industry group level, country level. So indexes represent entire markets in a country. Most often, technical analysts operating in one country will only track the benchmark in other countries rather than an entire series of market segmentation. So if you're trading in the Indian markets, before the market opens, you usually check the SGX, right? SGX is the Singapore Nifty. So why do we check SGX before the market opens? Because that's the market which is closest to our market. It opens like, I think, 2 hours before our market. So these are my Asia Pacific markets, this is my European markets, and these are my Americas markets. Regional level. Now on the regional level also the indices can be bifurcated. So indexes that seek to represent markets on each continent. So we have the EFA, which is Europe, Australia, Asia and Far East. We have the Global Dow, we have the Latin America 40 and Stocks Europe 600. So you can read about these indices if you're interested. They basically have a combination of equities from various different places. Now we have market capitalization. Market capitalization basically speaks about the value, right? So within a country, indexes can represent stocks by their market cap or market value using just the Russell indexes. So the Russell index, it is a very, very famous index. The Russell 3000 index tracks virtually the entire US stock market. Okay, so it contains 98% of its market value. The Russell 1000 tracks top 1/3 by market value. So how is it choosing the 1/3 stocks? The 1/3 stocks are chosen on the basis of their market value. The Russell 2000 tracks the bottom 2/3 and it is a benchmark index for small stocks. So you know that if you want to track an index which has only the smaller stocks, then you can track the Russell 2000. So that is what is my market capitalization. Now we have sector. What is sector? Within many global stock markets, Indexes track different sectors of the economy, such as financial, technology, consumer staples, energy. Now, this is again talking about bifurcating it into different sectors. So, this is my NASDAQ Bank Index. So, this is the US Bank Index, the US banking stocks. The same way we have Nifty Bank in India, this is the US banks. Industry. You can also bifurcate it on the basis of industry. Like, for example, in India we have another index known as the Fin Nifty or the Nifty Fin. That index basically tracks all the finance related stocks. So like that you can also bifurcate into industry. You can bifurcate it on the basis of industry. So you also have an index for pharma stocks, just the pharmaceutical companies. Other can be any other basis. So what is the benefit of investors for people like us who are trading in the market? Why should we even look at these indexes? Because see, the index is going to give you an overall view. You can't sit and track all the 50 companies at the same time, right? So the Nifty 50 is basically giving you an overview of the entire market. So that is saving a lot of time and also making things less tedious for you. So while the stock market is rife with indexes of all types, other asset classes also have indexes. The following is just a small types of non-stock indexes available. Okay, so these are my other indexes. We also have other indexes. Right, until now we have been discussing the equities or the stocks, right? We've been discussing various types of, indices which include various forms of equities. But there are other types of indices as well. For example, we have the currency pairs. So the currency pairs also have an index of their own. So the US dollar index, that is also something which is there. I'll show you that to you on TradingView. Look at this. So this is the US dollar index. Here you are basically seeing the value of the US dollar, right? So it does not, this chart is not including any stock or any equity, right? This is a currency. So there can be indices which are made of something else other than your stocks. So that is my US dollar index. So usually people see the US dollar index when they are trading other stuff because it gives you a clear picture. For example, I trade in metals. So something I usually observe is that when my dollar strength is very high, then my metals fall down, and when my dollar is weakening, my price of my metals go up. So that is what is a kind of relationship which I personally see before taking a trade, right? It's not a tip or anything, that's just one of the criteria which I use. So like that people use the dollar index for various purposes, first thing. So let's see another non-equity non-stock index, which is the CRB index. So what is the CRB index? The CRB index is basically the Commodities Research Bureau index. So the Commodities Research Bureau index basically is showing you all sorts of energy, industrial, agricultural. So it basically shows you the overview of commodities. How is the commodity market performing? So that is what is shown by the CRB. CRB So CRB is going to basically show you that. And in India, this is the MCX. So the MCX, the multi commodity exchange, is basically showing you how the entire commodity market is performing, right? So this includes silver, zinc, cotton, crude oil, natural gas, like all the commodities which are there. Just like the MCX index, the CRB index is for the US markets. Okay. Now we also have real estate. So there are indexes which basically track the real estate prices too. And there are people who actually trade in real estate as well. We saw in the previous chapter what was REIT in the exchange traded products. So the real estate is also tracked by an index, and usually it is represented by real estate investment trusts. Primary index is Primary index is FTSE Nareit US Real Estate Index. Just keep this name in your mind because it might be tested in the exam. So whenever FTSE Nareit US Index is mentioned, you know that they're talking about a real estate index. Now we have Baltic Dry Index, BDI. So what is Baltic Dry Index? Baltic Dry Index is basically created by London-based Baltic Exchange. Baltic is basically raw materials. So this is an index which tracks the, the dry index. What do I mean by dry index? The shipping size. So there are various dry products which are shipped from one place to another, right? So the Baltic Dry Index is based in the London Stock Exchange. It serves as a measure of cost of transporting various raw materials. So it shows you the shipping costs of transporting dry materials. This Baltic Dry Exchange, the Baltic Dry Index does not include the transportation costs of wet products. It only has the transportation or the shipping cost of dry materials. So that is my Baltic Dry Index. Keep in mind that it is just located in the London markets. Alright. Now we have LIBOR. LIBOR is basically London Interbank Offered Rate. So the LIBOR index basically shows you the changes in the interest rates. So the LIBOR index basically tracks the interest rates, especially in London. The full form is London Interbank Offered Rate. So it tracks the various interest rate changes in the markets. So interest rate charged by the banks when they borrow from one another. So that is my LIBOR. So LIBOR is a global standard, but there are similar rates which are available. For example, the HIBOR, TIBOR, SIBOR. So they are of the other countries. So LIBOR is also very important because it helps you check the interest rates at which the bank is borrowing from one another. It also helps you to mitigate risk and manage your risk. As of this writing, controversy over the process of setting and reporting LIBOR has given rise to other rate indexes. One such index gaining widespread acceptance is called SONIA, Sterling Overnight Interbank Average Rate, and SOFR, Secured Overnight Financing Rate. So the SONIA and the SOFR, these two rates indexes, they are also gaining a lot of acceptance other than my LIBOR index. Now we have bonds. So bond indexes, we know what government bonds are. The bond index is going to basically track the yields of the bond. And the US aggregate bond index, market iBox, USD liquid high yield index, city emerging markets. So these are various US indexes which are going to track the yields of the bonds. Okay, so we saw all the types of indexes. We saw the US dollar index, the CRB index was the commodity index, real estate index, and we saw what is Baltic Dry Index and LIBOR. Okay, so now we'll talk about how is an index constructed, and after constructing, how is the index basically weighted. So there are many ways to construct an index. It has its benefits and drawbacks. The most used method of weighing an index is capitalization weighted. So you are basically weighting everything on the basis of its capitalization. So most indexes use this method. The value of each individual stock in the index is weighted by its relative market capitalization. So what is market capitalization? We have discussed this earlier. Market capitalization is the price which is multiplied by the outstanding shares. Price multiplied by the shares outstanding and then divided by total market cap. So this is my capitalization weighted method, value weighted. So when you're doing value weighted, you are basically using market capitalization. So you are doing price multiplied by outstanding shares divided by the total market cap. So by doing that, you get the weight of your index by using the value method or the market capitalization weighted method. First thing. Now we have modified capitalization weighted. In the modified capitalization weighted, the calculations are the same as for regular capitalization, but there is a limit for how big any individual stock contribution can be. So in the first method which we saw, the value weighted method, it is kind of weird. Why? Because there are some stocks which might have a high market capitalization and some stock which might have a low market capitalization. So in that situation, the biggest stock is going to have the biggest value. But that's not really fair, right? So to deal with that problem, they had come up with a modified capitalization weighted method. So in this, what happens is that there is a limit on how big a company can be. For example, the index might require that no stock be allowed to grow to represent more than 10% of index movements. So no stock is going to be responsible for more than 10% of the movement in the index. So this is one such thing. The third thing is equal weighted or unweighted. So equal weighted is when all the stocks are given equal weightage in the calculation. And then we have the price weightage. So price weighted is also used by the Dow Jones index, right? So the price weighted indexes are the easiest to calculate, but at the same time they do have their own drawbacks. They ignore market values and are greatly affected by stock splits. Okay, so these are my different methods of calculating my weight of index. The first thing is the capitalization weighted or value weighted, and then we have modified, and then we have equal weighted and price weighted. Now let's talk about what is survivorship bias. Sponsors of indexes add and remove stocks from their products periodically. For example, a stock falls below a capitalization threshold and is removed from an index. A different stock is then elevated to the membership in that index because the original stock is in decline and the new stock is presumably doing well. Therefore, the fortunate of the index change for the better, even if only by a small amount, and the market or segment it represents looks strong. Unless the investor or analyst makes the effort, they do not hear much about the removed stock with regard to the performance. The surviving index continues on its way. So that is something which is a drawback. Let me just explain, even if you didn't understand what's written. If I have my Nifty 50, if a company is doing bad, it gets removed from the Nifty 50 index and it gets replaced with a better company. So the Nifty 50 index is always going to comprise of the best 50 stocks only. So no matter if any stock is doing bad, it just gets removed from Nifty 50 and something else gets added. So that is survivorship bias, right? So even when the stocks are getting removed, the Nifty 50 is going to keep doing good only. Why? Because the stocks are keeping on changing. So that is the survivorship bias. Using indexes do not trade in the cash market, so obviously you can't buy an entire index to yourself. If you want to trade in indexes, you can trade using futures or the options. Now, what are the data types that are available? So indexes are obviously calculated from the underlying stocks. What is underlying the index? It is the stocks which comprise the index itself, right? So most indexes will provide intraday data, price and time, so there will be open, high or low data. Others will only calculate a close value at the end of each trading day. So this is my DJT, which is my Dow Jones Transportation Average. So this is the transportation index of the US markets. So what does a technical analyst need? Indexes are simple in terms of charting. A technical analyst needs the closing price and probably the open, high and low. While volume may be available, it may not always be reliable. Unlike many other instruments, non-price data is also important, especially the industry sector, market cap and country it represents. A utilities index will trade differently from a biotech index. An emerging country index will trade differently from a developed country index. Finally, small cap indexes will trade differently from large cap indexes. So that was my overview about indexes. So when in whatever markets you're trading, make sure to always look at the overall index so that your vision in the stock is going to be on the side of the index itself. Why? Because end of the day, the stock is a constituent of the index itself. So it's going to be good if you play the trade in the direction of the overall market itself. Thank you.